In this video, I will show you 5 rules to find undervalued stocks for 2025. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in undervalued stocks. So, seems like this rule works to outperform. So, if you want to buy cheap stocks for 2025, I will tell you how. So, what is an undervalued stocks? This is maybe the first question you have to look for, and this is our rule number 1. When we talk about undervalued stocks, we mean cheap stocks, valuation wise. So you all know the metrics, the price earnings ratio, price to free cash flow. The first thing I want to focus on in this video is the valuation. We will not purely talk about the valuation in this video. Don't worry, there will be other topics, but for sure the first one is valuation. What is a cheap stock? Now, as I'm recording this video, the PE ratio for the S&P 500 is around 30 for the US market. So everything with a PE ratio at 25, 30, 35 could be considered as fairly valued. If you want to buy cheap stocks, you want to buy good companies available at a discount to the market. So now with the PE ratio for the S&P 500 at roughly 30, anything below 15 could be considered as undervalued. This is not the only criteria, but if you have to run a screener to find new investment ideas, this is a very good starting point. If you're in your screener, you put PE ratio below 15. And I would add to that a price to free cash flow below 15. I will not talk about the price to book. I will not talk about the price to sales because it depends for every industry, if this is a software company or a brick and mortar company. Now we want to consider valuation as a global stays, as a global valuation metric, so earnings, free cash flow. This is what matters. And let me add to this rule that a cheap stock is a stock that will generate a lot of free cash flow in future years. So a second rule for you should be don't invest in unprofitable companies. Most of the time, unprofitable companies are struggling business models. Most of the time. You have some exceptions, but most of the time this is the case. And now, given the current environment, I would recommend to only focus on profitable businesses. This is why we use these metrics. We use earnings because the company should have earnings. We use free cash flow because the company should generate free cash flow. I'm not talking about operating cash flow, financing cash flow, just the free cash flow. You take the operating cash flow minus the capex, you have the free cash flow. Okay? So only profitable companies and at a cheap valuation below 15. So let me put another letter here, P for profitable. Okay. Now, for a company to be cheap, undervalued, is not enough to just look at the valuation and say it's cheap, because you will have cheap companies with a PE ratio of 12, but these companies don't generate much growth, don't have much growth, and the earnings will collapse over the future years. You have this example for some banks, you have this example for, Boeing or car dealerships. You have a low PE ratio on an absolute basis, like some companies have a PE ratio of 6, but the earnings for the coming year will completely collapse. So, let's take an example. If you have a cheap PE ratio, a cheap company with a PE ratio of 10. If for next year the earnings are cut in half for our valuation metrics, the PE ratio is not 10 but it's 20, and now it's no longer overvalued. It's no longer undervalued. Sorry, it's no longer cheap. So I would add a new rule to that: is you want the business and the earnings to be either stable or growing, and as Warren Buffett would put it, you need a 90% accuracy rate on this one. You need to be 90% sure that the earnings will either be stable or growing. So I would say E for earnings, let me put S, stable or growing. Okay, because if you invest in a low PE ratio and the earnings collapse and collapse and collapse years after years, at the end of the day, the stock will not go anywhere. At the end of the day, the stock follows earnings. A stock follows earnings for the long term. This is what we do in this YouTube channel. So only invest in companies with stable earnings or growing earnings. And you will see a major difference here. For companies that have no growth. It's sometimes the case. You have some retailers in the US in this situation. Some companies have no growth, stable earnings. What is a good PE ratio for a company that doesn't grow? That's a good question. On average, that's 7. You have your answer. So if you think 7 is cheap, a PE ratio of 7 is cheap, that's a crazy deal. See the growth. See the earnings growth. If the PE ratio is 7 for a company with absolutely zero growth, it's not cheap. It's fairly valued. Okay, so that's a good distinction. I see some people on Twitter, on the investing sphere, making this mistake. Companies that don't grow much deserve a discount. And if a company grows, it depends. Do they grow 5% per year? Do they grow 10% per year? 15% per year? I'm talking about earnings here, not revenue, just earnings. So it depends. And the higher the growth rate, the higher the valuation most of the time. So if you grow 5% per year, you can have a PE ratio of 10, 15. And if you grow your earnings 15% per year, now you can have a PE ratio of 25. In this case, maybe it's fairly valued, maybe it's cheap. It depends on every situation, given the market conditions, etc. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. What I want you to focus on here is to be 90% sure about this growth. This is extremely important because if you do a mistake, I know it because I've done this in the past many times. You invest in a cheap business, but the earnings collapse. So at the end of the day, the PE ratio doubles and the stock is no longer cheap. It's the case. It's a major trap. So be careful and don't fall into this trap. Don't do this mistake. Be very sure. And that is also another rule for you. Stay inside your circle of competence. How do you build a 90% conviction in the growth rate for the earnings? It should be a company that you understand. It should be a company in your circle of competence. Something that, okay, you know the market dynamics, you know if the market will grow, maybe you are a customer of this brand. For example, Spotify, if you want to listen to some music, you can be sure that the earnings will grow, for example. Maybe you are very familiar with the matter. Same thing with Google. Over the next 5 years, are earnings going to grow? My guess is yes. And am I 90% sure? My guess, that's my personal opinion, is yes. Maybe you will disagree, maybe something else, but stay inside your circle of competence. Stay inside your circle of competence. Focus on companies you really know, you are familiar with. Okay, let me move on. Another thing that is very important, I mean, you will have more than 5 rules in this video. This is a video full of value, and I want to talk about ROIC now. ROIC, in case you don't know what that is, that's the return on invested capital. That's your reinvestment rate. If you reinvest $1 in the business, how many dollars do you have at the end of the year? If your ROIC is 20%, you get a 20% reinvestment rate. So if you want to find undervalued companies, 1, you look at valuation. 2, you look at the growth rate for earnings. 3, you look at the ROIC. I'm talking about numbers here, quantitatively. ROIC should be quite high. I mean, if you have a ROIC above 10%, that's decent. You can have some cheap companies here. If you invest in a low PE ratio company, in a cheap stock, and they have a very low ROIC, it means that maybe the business is not efficient. But that's not your goal. You want to find undervalued stocks that are efficient and will produce more earnings in the future and will make you a lot of money. That's your goal. That's why you clicked on this video, right? So you want to invest in strong businesses that will grow or be stable with earnings and they have some efficiency. Let me write again this 0. I don't like it. So if you focus on a ROIC higher than 10%, that's good. That means some efficiency around the business. Now let me continue. I want to talk about the balance sheet, BS. If you invest in a cheap company, but the company has a lot of debt, maybe they will use some of the free cash flow to pay off the debt and not reinvest in the business. The best scenario to find an undervalued company for 2025 is to invest in a business with no debt or with low debt and a lot of cash. Where do you see this? You see this in the balance sheet. Because now, in 2025, interest rates are around 4%. Okay, some companies have to repay their debt. Some of the cash flow at the end of the year will be used to repay debt or take more debt. This is not the best use of capital right now. If you are a company, imagine you are a CEO of a public company and you want to reinvest inside your business, reinvest in the business to grow and grow and grow. You don't want to use some of your cash to pay off debt. I mean, the best investment opportunities for 2025 will be the companies with some good amount of cash without debt. So you can check the balance sheet, see if the balance sheet is healthy or not. You will find, if you do this exercise properly, you will find some companies with a lot of debt and no growth that will be very bad, and that's where you call what you call a value trap. The PE ratio will look low, but the earnings will collapse and they have a lot of debt. So this is not what we want. We want companies at a cheap PE ratio. Earnings will grow, ROIC is higher than 10%, and the balance sheet is healthy with a lot of cash, growing cash, and almost no debt. That's the best case scenario. Now, I want to finish this video with a market timing thing. When do you buy these stocks? Maybe you will run a screener and find good investment opportunities in the US or elsewhere with all these criteria. When do you buy these stocks? First, you buy them when they are inside your circle of competence. Don't go outside your circle of competence because that's where you lack information, so you will make a mistake probably. It's better to stay inside your circle of competence. And second, when do you buy? You buy these cheap companies when the stock price drops because of a temporary problem. It's not the company has a problem, but it won't kill the company. It won't destroy the investment thesis. It won't destroy the business model. And how do you know if a problem is temporary or permanent? It all revolves about the circle of competence question. If the business is really inside your circle of competence, you have some expertise, you are an expert about this industry, this company, so you know if this is a permanent problem or a temporary problem that will be solved out in 6 months. The best case scenario is this. You find all these great businesses available at a cheap price, PE ratio lower than 15, okay, very nice, growing nicely, high efficiency, good balance sheet, and you wait. And you wait when they have a problem, a temporary problem, and the stock crashes 20% and you have some panic. And while other market participants are struggling to understand the situation, you have done the work. So please follow these steps. You have some rules to find undervalued stocks for 2025. And I guarantee that if you follow these steps, you will make a great return. You will have a great return for 2025. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.